So in order to understand the accumulated other comprehensive income in detail, let's closely look at the balance sheet of this company A. So on the left side we have the assets, we have the liabilities here. Now assets, let's assume cash is 20, this is current assets, and then we have inventory, let's say this is again 100. Then we have some marketable securities, this is another 100, and let's say the long-term assets, which is property, plant and equipment, let's say this was around 800. So this total on the left hand side is basically equal to 1020. So this is our asset side, and what we have seen till now for this company A was that the liability consisted of two parts: debt, which we have seen that was raised as 600 earlier, and the shareholders equity, which we saw earlier, was 420. So this 420 actually came from four parts. One was the common stock, I'll write this as CS, and this is $100. Then we had the additional paid in capital, this was $300. We saw that we had the treasury stocks, so this was $20 with a minus sign. And lastly we had the retained earnings, so this was around $40. So we had this as sum total of 420, so that the left hand side was again 1020 equal to the right hand side. So now let's take a situation where inventory, as we have seen earlier, needs to be represented at lower of the cost or the market value. So we have looked at this earlier, lower of the cost or the market value. Let's assume that this cost, which is 100 provided here, actually is not correct. However, the market price is, let's say, $90 and the cost price was $100. So if we had applied this lower of the cost and the market price, this would be lower of 100 and 90. So ideally our inventory would have been reported at 90. So here we would have kind of made a change. Instead of 100 we must write here as 90. So what will happen to our asset side? Our assets will change from 1020 to 1010. So this will be the change on the left hand side, that is the asset side. Now look at the liabilities. Your liabilities are still at 1020. So your assets should ideally match the liabilities. So where will this difference of 10 actually flow from? So we have seen this earlier, that net income or the income statement that results in net income is linked to the retained earnings, right? So here in between the sales and the net income, what we essentially do for this case of inventory is that we write an expense which will be called as inventory write down to an extent of $10. So what will happen in turn is that your net income will reduce by $10, and when this gets reduced by $10, instead of $40 here, what you'll have is $30, and instead of 1020 then you'll have 1010, with shareholders equity section not being at 420 but this will be 410. Now let's assume that there was no change in the inventory and there is a change in the marketable securities side. So let's say the marketable securities were not 100 but they were actually 90. So let's say the market price of these marketable securities have reduced to 90. So what will happen again is that you will report this at the fair value, and here it will be 1010. So if we go back and look at what we did in the case of inventory, in inventory what we had looked at was if there was a reduction in inventory, we had looked at the income statement. Within the income statement we have written an expense which was called as write down of inventory to an extent of $10, and this resulted in lowering of the net income, and this net income was ultimately linked to the retained earnings, and this was reduced to $30. Okay, so this was what we had done in the case of inventory. But what we will do in the case of marketable securities, should we do the same thing? Should we actually take a hit in the income statement and write down as expenses? Now the problem is that in some cases of marketable securities you are allowed to do this, But in a few cases, like for example, if your marketable securities were classified as available for sale. Available for sale essentially means that you are wanting to sell this stock, but you're looking at a profitable opportunity, and that profitable opportunity may not come in the near term. So if that marketable security has been classified as available for sale, you are not allowed to pass this expense or the loss through the income statement. So you cannot do that. You're not allowed to do that. So what we need to do in this case here is that there is a direct adjustment in the shareholders equity section. Here you will directly adjust, and we will call this as accumulated other comprehensive income, and this will get reduced by 10. So here it will be a loss. So you understand where this accumulated other comprehensive income is coming from. There are certain adjustments, certain losses or certain expenses which are not allowed in the income statement. So if these are not allowed, on one side you will have assets which have been lowered, on the right hand side the liabilities should also lower by a similar amount. So there is an account that is created for this. We call this as accumulated other comprehensive income, and we do a direct adjustments here so that the assets are now equal to the liabilities. So this is the whole concept of accumulated other comprehensive income.